All right, how's it going, everyone? My name is Amos, and let's go ahead and talk about all of the stocks that are reporting their earnings this week. And by the way, I hope everybody had a good and a restful MLK weekend. And as you can see on your screen right now, dude, there's a lot of heavy hitters that are reporting their financial progress this week, but also earnings is an opportunity for the companies to update their guidance going forward. So that way you're not caught with your pants hanging down by your ankles and you have line of sight of any setbacks or headwinds that a company might be facing. Because they're publicly traded, they have to do that for the investors, right? So on a very high level, we have Netflix, we have Johnson & Johnson, we have Procter and Gamble right there. And then a bulk of this list is going to be full of regional banks. Because last week were the major big banks, now it's the little guys. And yeah, there's so much to talk about, so let's go ahead and get into it. By the way, if you can't tell, it's going to be more of a chill, relaxed vibe. Okay? All right, so to kick things off, let's go ahead and see what's happening on Tuesday. So I think the biggest name is going to be Netflix for sure. And the estimation, I'm not going to lie to you, that's a lot. Wall Street expects their bottom line per share to be growing 27% year over year. And the top line growth, at least 16.8%. There's very high expectations for Netflix. I'm going to be honest with you, I think the key metric here is going to be their subscriber growth. Because I think they're going to smash their financial numbers. Whatever numbers are ever laid out, they always surpass it and raise their guidance. I don't think it's going to be any different this time around, right? Are more and more people signing up? And I feel like at this point, they've reached market saturation. I mean, the US and Canada alone, there's 89 million paying members. Europe and Middle East and Africa, there's 101 million. Asia's 57 million. They always find a way to keep finding new people to sign up. And they also introduced an ad tier membership. So I think the markets are going to be paying close attention because I think there's high expectations baked in with that, right? Because I think it comes at like half the price of a normal membership, but you get shown ads. And Netflix will make money from said ads. And they've also been going on a massive sell-off, right? I think they reached the absolute high back in June, about $134 a share. Dude, they're $88, and based on my technical analysis, there is no line of support. They are free falling. So Tuesday is either going to be a make or break. I'm calling it right now. They're either going to make every investor so bullish that it's going to rebound, or they're going to fall further. I don't want to be a negative Nancy here, but to say that they might be $70 by Friday, that's a reality, right? And that's because, a few things happened. They're pushing really hard right now to acquire Warner Bros. Discovery, and some people hate it. I'm on the camp of, I think it's smart. They're diversifying their business in terms of introducing the traditional modality of media, but also the intellectual property, the evergreen content surrounding the Superman franchise, Harry Potter, and even Scooby-Doo, right? I feel like that's huge value add to Netflix. I think it's going to be a good thing for them. The downside is that they're about to take on a crap ton of debt. And their books are about to look a little hairy. Because right now, I think their books, when I say books, I mean the balance sheet, it's pretty solid. Their total debt, $17 billion, and that's about to get way up there. Because once you buy out another company, you also take on the loans that are on their books. But if you take a look at their debt to EBITDA, it's a 1.2. So it would take them roughly 1 year and 3 months to pay off all of the debt on their books, based on their core operating profits remaining the same. So it's not too bad. But Warner Bros., I think they're really, they're drowning in debt. So it's going to be a change of scenery for them. We also have 3M. U.S. Bancorp, Fastenal. Let's talk about Fastenal. This is a very interesting company that most people have never heard about. But not only did I work as a strategy guy in pharma, but I also worked in the supply chain space. So this is a company that I got to learn about when I worked in operations, right? Okay, so here's the weirdest thing about them. They essentially put a mini hardware store within a manufacturing hub or a factory. So when you think about like a Ford plant or at a Newport News shipyard or even inside of an Amazon fulfillment center, they'll have a Fastenal guy that runs that tiny little Home Depot or Lowe's. Or they'll have a vending machine. And inside of that tiny little mini warehouse, if you need some kind of like a screw, a specific part, a bolt, or a pair of gloves, they've got you covered. That way, you don't have to shut down your operations to run to the store. All of the supplies and ingredients you need to keep the industrial machine running, that's Fastenal. And of course, they do more than that. Leading up to the last earnings report, dude, this company was, what would you say, about $50 a share? But then, ever since their last earnings report, they went on a huge sell-off. And now they're slowly starting to recover year to date. Just in the past 3 weeks, 9% into the green. But yeah, I think this one's going to be interesting to keep an eye on because it'll give us a pulse on how our manufacturing and industrials are doing, right? Yeah, their numbers are absolutely phenomenal. And their dividend profile, 2% dividend yield, 12% dividend growth rate. This is absolutely a dividend compounder with cheese. I mean, a 200,000% share price appreciation since their inception. That's not baking in the dividends paid out. So I kind of wish I had Fastenal on my watch list because when they went on that sell-off back in December, or I guess end of November, I wish I would have bought into them, but I wasn't aware. So I think Fastenal, I think this is my good reminder that I'm going to put them on my watch list. That way, if something happens in this earnings report where the market overreacts, I'm going in. However, if they sell out of them for a justifiable reason, like, oh my gosh, we have decided to go into the business of selling cupcakes, of course I'm not going to jump in, right? But anyways, what else do we have on Tuesday? Oh my gosh. At first I was like, wait, what? United Airlines, because I'm a shareholder of United Health Group, but it's the wrong United. I have no interest or desire to tune in or to figure out how the airlines are doing. I just genuinely do not care. We've got some major banks right here, regional bank right there. I'm pretty sure Tuesday is going to be a lot of the regional banks. I might have to just jump on over to Wednesday. What do we got on Wednesday, friends and family? Oh yeah, we got Johnson & Johnson, probably one of the more appreciated and loved dividend payer in the pharmaceutical space. Charles Schwab. Oh yeah, let's talk about Prologis. So they're a REIT in the business of renting out warehouses for everybody that's involved in the supply chain game. And this company, dude, surprisingly, only a 300% return, but that's also because in the past 3 years, REITs as a whole, collectively, they've been getting their knees smashed by a hammer because of the high interest rate environment. But Prologis is a company that I think is kind of cute. I think they're really nice. Very solid, dependable, reliable, compounding. I mean, obviously, I shouldn't be looking at the EPS because it's a REIT. Because we're talking about a REIT, I think this website is 10,000 times better than stockanalysis.com. Stock Analysis looks at stuff from a GAAP basis, which makes sense for 99% of publicly traded stocks. But when it comes to a REIT, you got to be looking at it through the lens of a REIT, right? You can't really be trying to shove a circle into a square peg. But their REIT score is 100 out of 100. I think that's really good. Their trading multiple is a 22, because in the world of REITs, you look at the funds from operations, the FFO. In a perfect world, the AFFO, the adjusted funds from operations. So you can kind of think of that as like, quote unquote, their PE ratio being a 22. 5-year average is a 22, so they're not undervalued. They're trading for what they usually do. 3% dividend yield. Let me see. The payout ratio for their dividend is 67%. If I jump on over and show you what it looks like on a GAAP basis, it would say their payout ratio is 117%, but that makes no sense, right? Because legally, a REIT is required to pay out at least 90% of this number right here out as a dividend in order to get beneficial tax treatment. So 67% payout ratio according to their AFFO. Dividend growth rate is 5.2%. And then what are we seeing here? Their AFFO, you could kind of think of this as like their net income or their free cash flow. The fact that it's growing every single year without fail. I mean, what I'm trying to say to you is in the REIT space, I think Prologis is pretty high quality. Occupancy rate is 95.3%, but it used to be, what, like 9, man, that is so freaking small. I can barely see it. 97%, 97.5%. So it is on the downward trend, which is not a good look. The largest paying tenant, about 5% of all of their available warehouses, is Amazon. Yeah, there's a lot to like about Prologis, but I don't think they're undervalued whatsoever. As a matter of fact, if you didn't catch them in this dip right here, April 2025, or this dip right here, December 2024, I don't know. I personally would not want to jump in when they're $133 a share. Just me. Let's see, what else do we have on Wednesday? Prologis, Kinder Morgan, oil and gas, travelers, companies. By the way, did you guys watch the insurance industry breakdown video that I did where we dissected, like, what was it, like 25, 26 insurance stocks? From my memory, I feel like Travelers, their grade was an A+ or an S, right? So this is an insurance company that is absolutely high quality in almost every single regard. But I remember I walked away, because this was like a few months ago. They weren't undervalued whatsoever. You might see this and think they're undervalued, but the insurance space as a whole, they usually have a low trading multiple. But Travelers Insurance is really good. Take a look at their books. What's their float? $103 billion. My goodness gracious. If we want to talk about an undervalued stock in the insurance space, I don't think Berkshire Hathaway is undervalued right now, but Progressive, on the other hand, I think they're absolutely undervalued right now. As you can see, they're at a 1-year low at the time of making this video. The fundamentals and financials for Progressive is absolutely insane, just like Travelers. What's their float right now? $94 billion. My gosh. But anyways, if for some reason Travelers, they go on a massive sell-off, I think it might be an opportunity for me to jump in because I want more exposure. I don't have any exposure. I want exposure to the insurance space. Having said that, I would only want to buy into the top tier ones like Travelers, Progressive. I'm trying to remember, what was the other one? I think Berkshire Hathaway was an A. I don't think they were an S. Yeah. Anyways, Citizens Financial. There's a lot of random little banks. Oh yeah, Pinnacle Financial Partners. About a few weeks ago, I uploaded a video talking about it. Oh my gosh. There's an entire industry that's full of dividend compounders with cheese, and they're going on a massive sell-off right now. And I shared with you guys, I think, my list of like 10 that I'm eyeballing. And I think Pinnacle Financial Partners is on that list, if my memory serves me correct. This is a really good company. It's just right now they're going through setback after setback. And yeah, I think I am going to tune into their earnings because I might jump into this one. Anything else we got going? A lot of regional banks. By the way, do not dismiss the regional banks. I'm saying it right now. Like, go watch my video that I uploaded talking about them. And I think it might change your opinion because regional banks are actually higher quality than I previously thought. Yeah, let's jump on over to Thursday. I think Thursday is a pretty busy day. I think there's a lot of big names right off the gate. You know, we have Capital One. We have Intel, we have Procter and Gamble. Let's talk about Procter and Gamble, dude. This company has just been getting shattered for the past 1 year, negative 10%. And that's because inflation and tariffs, it's been hurting them pretty harshly, right? And I don't know if this is good or a bad thing, but their sell-off, it gave me the opportunity to buy into them last year. And it's a company that I've been watching and monitoring for 7 years. And the fact that I finally bought into them, I was like, oh, hooray. But what's not so hooray is, you know, they're facing a lot of difficulties right now. And I remember in one of their earnings calls, I don't know if it was the last one or the one right before that, they were saying like the consumers are pulling back on spending money on buying detergent, on toothpaste, and razors. And I just kept thinking, I'm like, dude, are people not going to be washing their clothes anymore? It's like, gosh. Like, I know that inflation at one point was ridiculous, but like, we still got to buy that stuff, right? Because I don't know about you, man, but when I think about Procter and Gamble's portfolio of products, I feel like it's best in class. You want to talk about the pound for pound best dish detergent, it has to be Dawn. Like, that's the one that scientists, that's what they use to get the oil off of birds, right? Dawn. But anyways, the best pound for pound laundry detergent, it has to be Tide. I think Persil could be a part of that conversation, but I think that parent company is Henkel. It's not Procter & Gamble. Tide, number one. You talk about toothpaste, it's got to be Crest. You want to talk about floss, it has to be Oral-B. And the list goes on and on and on. I think I said it before, and it might be unpopular, but I think Colgate, Palmolive, and Church & Dwight, they're a distant second and third place in every category that Procter & Gamble operates in. But this is a company that I don't mind just holding on to them, even if they're going on a sell-off. You take a look at their entire timeline in history, they've gone through sell-offs before and they've recovered. They've gone on sell-offs before and they've recovered. This time, I don't think it'll be any different. I don't know when the sell-off is going to stop, but yeah, I'm not too worried. It's not like I'm just going to sell and jump ship unless they cut the dividend or they just go on record by saying some diabolical racist stuff about how much they hate Korean guys that make stock market content. I'll take that personally. I'll be like, all right, I'll sell out. Okay, I'm out. What's another one that we could talk about? I guess we could talk about Intel. Dude, this is a company, I'm not even going to lie to you. You look at my channel about a year and a half ago, I talked smack about Intel. I said their financials are rough, their roadmap, I don't believe in it because they were exiting their traditional money-making lines of business and they were trying to become the manufacturing hub for AI chips. And I kept saying like, man, I don't know, right? Well, they proved me wrong. Because the past 1 year, we're talking about 138% into the green. Are you freaking kidding me? But I mean, look at this. All the signs were there that they're financially distressed and they were ugly, right? Negative. Like when I made the videos about Intel, their profits per share were negative $4.38. It's not like I was speaking out of my butt. I was referring to their financials and fundamentals and how disgusting it was, and it was. But it just goes to show, like, their free cash flow has been negative since 2022. Right now, it's negative $8.4 billion. That's because they're doing a lot of cap. If I scroll up here, I can show you they're doing a lot of CapEx right now to build out their foundries. $16.9 billion of CapEx right there. But I guess it doesn't matter because I think the market, I think with Intel, they're forward-looking. And I'm personally not interested in Intel, even though I know 138% into the green. But, with the geopolitical tensions that's happening, and the fact that they are an American-based company. I said it before and I'll say it again, right? American-based companies, it's in our best interest to rescue and save them rather than to let them fail. That will always be the default option when we think about Boeing, because the alternative is the French plane company Airbus. With Intel, if we let them fail, the alternative is TSM, and they're in the backyard of China. So it's like, And, I think investors, the reason why it's 138%, I think they're bullish on them. But the thing is, I just tuned into TSM's earnings, and they just reported, by the way, I think a week ago, they're doubling down and they're building more manufacturing facilities here in the U.S. And I think there's plenty of fish to fry for everybody, but right now, TSM, they're best in class when it comes to making the very complex and capable chips. Intel, on the other hand, they're trying to play catch up, right? Because this is not a territory that they're well versed in. Whereas TSM, their entire DNA and timeline has been making chips. So I guess only time will tell. But honestly, that's really shocking to see. So I will admit it, I got it completely wrong with Intel, and it goes to show that sometimes fundamentals and financials, it doesn't matter, because it could be atrocious, it could be all in the red, it could be all negative, and they defy the odds and still go 138% into the green. Now, obviously, Intel, it's a rare exception. It's not going to be happening with everybody on this list, right? Because usually your fundamentals and financials need to look solid and beautiful in order for your stock price to follow suit. But apparently that's not the case with Intel. Capital One Finance, I like them, but I feel like if you're going to go with one of the card, I guess they're an online bank as well. If you're going to go with one of the card players, I feel like best in class is American Express. Speaking in terms of the credit space, there's also MasterCard and Visa, which, for the past 1 year, this really shocked me. Prior to filming this video, I was just doing some market research and I was looking at Visa. Check this out. Visa, one of the best dividend compounders with cheese. Past 1 year, 3.8% into the green. That's it. That's crazy talk. MasterCard, I don't think it's any better than that either. I think they're in the same ballpark and territory. But their dividend growth rate of 13.5%, I don't know, friends and family. Visa, the numbers look great, right? 11% growth year over year, top line. Their EPS, just as juicy and beautiful. But I feel like everybody in the finance payment processing space is just getting hammered right now. Talk to me about Pfizer. Talk to me about PayPal. Talk to me about XYZ. Talk to me about Shift4, Toast. The entire market's just really bearish about anybody that handles transactions. So, I don't know. I'm going to have to do more research about Visa because if they are, in fact, they're undervalued, I might jump in. Because I jumped out of them about 1.5 years ago. I remember I made a video talking about it. I was like, guys, I just sold out of my entire stake in Visa, a company that I bought into in 2019. The reason being is I'm going to buy big into AMD and NVIDIA. Now, at the time, after I made that transaction, dude, I felt like such an idiot. I'll pull up their stock chart to talk about it. So I bought into them at the end of 2024, around December. I was like, goodbye, Visa. Thank you for your service. And immediately after I bought into AMD, at the end of, 2024 going into 2025, the price got shattered. Now, obviously, I dollar cost averaged all the way down to their April lows, but I think that was the right move. Because after AMD reached about $78, $77 a share, they rebounded as if there was no... Look at that, 93% into the green. So I think it was a right calculated move, but I had no idea that AMD was going to go 90% into the green while Visa was going to stay flat at 3%. At the time, I had to sell out of something in order to buy AMD because I don't have excess capital, right? For you guys watching this video, you might have a job that pays you like, $3,000 a week, maybe $10,000 every month. or 20 grand, dude, I'm lucky to see $200 to $500 a month from YouTube. So in order for me to jump big into a company, I need to sell out of an existing holding in my portfolio so that I can move some money around in order to maximize the compounding effect. And, at the time, I was kicking myself in the head. I was like, did I do the right thing selling out of Visa? I think I did. And I'll be honest with you, I got super lucky. I'm not going to even pretend like, I knew that AMD was going to go 90%. Like, I knew AMD was undervalued because my fair value estimate for them at the time was like 250 to 270. And some people laughed at me. They were like, dude, you're an idiot. You have no idea what you're doing. And did that actually pan out? Yeah, AMD, they actually reached the price that I exactly outlined and forecasted. So that part I will take credit for. I knew they were undervalued, but I didn't think they were going to hit 260 that fast because I thought it would take at least 2 years at a minimum. I didn't think it was going to happen in 6 months, or I guess like 7-8 months. So pretty happy camper on that end. And it's so sad to see Visa falling behind. They're really underperforming, especially in the S&P 500. There's Huntington Bank shares, another regional bank. I am not interested in any food CPG stocks. So when we talk about Campbell, Conagra, I'm just not interested, okay? I think, I don't know if I talked about it on the channel, but I talked about it in depth on the Patreon. No, I don't care that they're at a 10-year low valuation. I'm not interested. Southside, Old Republic. I told you there's so many regional banks that are reporting. Again, go watch my video that I uploaded about 3 weeks ago talking about why we shouldn't ignore them. Jump on over to Friday. I think there's Booz Allen Hamilton. It's a staff augmentation and tech consulting firm based in Nova, Northern Virginia. They make a bulk of their revenue from the 3-letter agencies that are in Arlington, Fairfax County, the Pentagon, but they're mostly known for partnering with the Department of Defense. I guess at this point it's called the Department of War. I always forget about that. And I think, honestly, if you've been keeping up with the news, then you know that Booz Allen Hamilton's earnings, it's going to be a hot mess, like straight diarrhea. Because do you remember the prolonged government shutdown that happened in October and November? So when a government shuts down and a company makes a bulk of their money from the government, you ain't getting paid for that because none of your consultants were doing work, right? So I think it's going to look really bad. But if you take a look at what's happening to them in the past 1 month, they're up in the green 6% because not too long ago, I'm trying to remember, was it last week? Was it a few days ago? The current party in power, they made an announcement saying, hey, we're going to try to increase the military budget to $1.5 trillion. Are you freaking kidding me? And when you think about it, Booz Allen Hamilton, their backlog of contracts is over $40 billion, and it's only going to get bigger. So, I don't know about you, but I do feel a little bullish about Booz Allen Hamilton. Unfortunately, I bought into them last year, and I sold out of them at a very small loss. I did not have the opportunity to jump back in. I'm trying to buy back in, and I should have when their CFO resigned out of the blue, and I think he did that back in December, and they went on a tiny sell-off. I should have bought back in, but I didn't. But Booz Allen Hamilton, not many people know about them, but it's a super high quality, asset light, no capital expenditures. Their financials and fundamentals look solid across the board. This is a really good company. I guess one could argue, no, it's not. AI is going to make consultants obsolete. Well, I guess we can extend that argument to lawyers. I guess we can extend that argument to insurance, actuaries, and every industry, right? But I feel like that day, I don't think it's going to happen in the next month or so, right? It's going to take time and years to make all of us lose our jobs to the hands of robots and AI. So you might as well live your life in the meantime. Anything else crazy happening on Friday? No, it's just a bunch of other regional banks. So anyways, let me know if you like this type of laid-back video, because it's been a while since I've done it, but it's something that I personally do every Sunday night, so I thought, might as well film myself giving some commentary and adding some color to this stock or that ticker. Because I'm sure other people out there are just as curious as I am as what companies are reporting, because that's when the buying opportunities happen, right? Based on their earnings, it'll either, sell off 10 or 20% into the red based on emotions, and then in the next week, it recovers. The chance to buy into them is right there and then when the emotional selling off happens. Or if you hold on to one of these companies in your portfolio and it goes up by 10 or 15%, at least then they must have reported earnings and wow, they're doing this. So, I don't know, let me know. And by the way, one last thing before I head out of here. Dude, I woke up this morning and I realized the channel has hit 20,000 subscribers. Are you freaking kidding me? Dude, honestly, I'm so stoked. And I'm going to go on my little soapbox and be genuine with you. I am so grateful for every single one of you. Even if you have a receding hairline, you're in this conversation, okay? Every single one of you that watches or leaves a comment on the videos, or if you just tolerate my rambling about dividends and stocks in general, dude, I appreciate you so much. Because I'm a small-time YouTuber, okay? I understand that there's other options out there, and the fact that you choose to spend it with me, dude, I don't take it for granted. So I'm hoping that as I keep making videos that I just get better and better as a YouTuber. That way I can give you better content, right? So circling back to the whole 20,000 subscribers thing, dude, I'm so excited because, tight on money with a newborn, but to celebrate, my wife and I are probably going to hit up some Korean barbecue, which is kind of expensive, right? Really excited about that, but we're also thinking about going to a fancier donkatsu place. So that's all because of you guys, okay? I love you, and I mean it when I say that. And stay safe, good luck in the stock market, and I'll talk to you guys next time.